Having first discussed the prospects for accelerating inflation more than 2 years ago, we continue to believe inflation to be more structural than transitory, or at a minimum for the transitory period of higher inflation to last longer than investors expect. I'm Brian Arcese, Portfolio Manager at Foord Asset Management. There are a number of contributors to these inflationary tailwinds, including the following. Underinvestment in traditional energy resources has and will continue to result in a supply crunch for many years before renewable generation accounts for a sufficient proportion of supply. Global supplies of many industrial metals, including copper and several rare earths, required to further the energy transition, are currently not sufficient enough to meet requirements. Agricultural inflation, though currently experienced acutely as a result of Russia's invasion of Ukraine, together the countries account for more than a third of global wheat production, will remain elevated as countries globally are forced to rethink food security and are forced to procure at least a portion of their required food intake at home, regardless of cost. Though we hope for a peaceful resolution of the current conflict in Ukraine, regardless of outcome, the countries that previously weren't convinced of the necessity to onshore a portion of strategic materials, including semiconductors, certainly are now. Even if only a portion of a country's semiconductor demand is onshored in the coming years, this will add to inflationary pressures. Corporate margins remain at record highs, plain to see demonstration of the fact that profits have flowed disproportionately to the owners of capital rather than labor. The reversal of this trend, already evident in many parts of the world, will continue with pressure on wages to remain or increase. Commodities and materials, as well as materials-linked equities, hold meaningful weights within both our Global Equity Fund and International Fund and offer a solid hedge against expected inflationary pressures. Second, though behind the curve, global central banks have and will continue to be hawkish in their endeavor to stop inflation expectations from gaining or establishing a firm foothold in the consumer psyche. As a result, the probability of over-tightening is far greater than zero. Third, though not yet reflected in consensus analyst estimates, earnings growth rates are and will continue to moderate. We expect earnings to be increasingly challenged in the coming quarters. Fourth, for reasons other than inflation protection, of which it has historically been little correlated, we continue to believe gold will maintain its safe haven appeal. The metal serves as a solid hedge during periods of volatility, whether market or geopolitically driven, and has posted some of the best asset class returns year to date, despite the headwind of rising real interest rates. Finally, select Asian countries and markets are attractive relative to many developed market peers. Of note, select equities and companies in China, despite being saddled with operating in an economy running far below capacity due to COVID restrictions, are trading at valuations far less than their intrinsic value. We have a material weighting to select securities that will benefit from growth in the Asian consumer. Finally, each of our funds remains conservatively positioned, with 1/4 of our multi-asset fund held in cash or cash equivalents, and sizable portion of our global equity fund held in defensive securities and securities whose valuations are well below their intrinsic value.